Let's understand what are the classes of share capital. We know that share capital is nothing but the money raised from the owners and from other group who are not directly the owners, but they are going to be called as preference shareholders. So share capital is basically money raised from those two groups. Okay, so the classes of share capital can be divided into two. Number one that is coming from equity shareholders, will call that as equity share capital, and the other one that is coming from preference shareholders, so we'll call that as preference share capital. So basically we have two classes of share capital. Now let's understand what goes into equity share capital. See, when equity share capital is issued, it can be issued with voting rights. Okay, it can be issued with voting rights, and it can also be issued without voting rights. Or to put it rightly, it is not without voting rights, but rather it is with differential rights. So please remember, it is not without voting rights, but it is rather with differential rights. So when we say with differential rights, that may be with respect to the dividends, that can be with respect to the voting, and various other aspects which we'll discuss later. Okay, so that's about the equity share capital, that is which can be issued with voting rights and with differential rights with respect to dividends, votings, and other things. Now we'll also touch on the preference share capital, which I'll show it in the next screen. We should know what is preference share capital, that is what is the nature of preference share capital. See, what makes a preference share capital to get this name? Because preference share capital or preference shareholders will have preference with respect to payment of dividend. So when it comes to the payment of dividend, the company will pay the preference shareholders first, and only then they'll go to the equity shareholders. So they have preference with respect to payment of dividend. Number two, they have preference in return of capital when the company is being closed. Because when the company is wound up, the people who have invested money should be paid back. So the sequence would be like the secured creditors will be paid first, then unsecured, then shareholders, and when it comes to shareholders, equity shareholders will be in the last, and before them preference shareholders will get preference. So they have preference in return of capital as well at the time of winding up of business. Okay, so please remember this. Next, we should understand that there are various types of preference share capital. What are the types? We have what is known as cumulative preference shares. So what is cumulative preference shares? See, we know that when it comes to the payment of dividend, preference shareholders have to be paid first, and only then equity shareholder got to be paid. But let's say in a year the company is not in a position to pay dividends because it is reporting loss. When there is loss, dividends cannot be declared. But if you are holding a preference share capital, or if you are a preference shareholder, then in the year of loss, yes, you are not entitled to dividend, but that dividend can be carried forward to the next year, and when next year dividend is paid, first the old dividends have to be cleared. That is dividends which were not paid during the period of loss, so that should be cleared, only then they'll move on to the new dividend. So that is called as cumulative preference shares. Then the second type of preference share is redeemable preference share. This redeemable preference share is available, the details are available in section 55 of the Companies Act 2013. Okay, and when we say redeemable, it should not exceed 20 years. That is, it should be redeemable within 20 years. So this means that companies cannot issue preference shares which are redeemable beyond 20 years period, but only exception is infrastructure companies. So in case of infrastructure companies, you can issue preference shares for the period exceeding 20 years, because the infrastructure projects will take a longer period, that is, there will be a longer gestation period, and hence this time limit is provided. Then the third type of preference shares is called as participating preference shares. So what is this participating preference shares? These shareholders will have right in surplus. So what is this right in surplus? That is, when we say the company is being wound up, all the stakeholders have to be paid back. You have to pay the secured, unsecured, then preference, and then equity. So after paying all these guys, if there is any surplus, okay, that is, even after paying equity shareholder, if there is any surplus, then people who are holding this participating preference shares will have right on that surplus. That's why we call this as participating preference share.